soaring prices and crashing markets. Who knows what the future holds, but some good advice can still save loads. Keep watching our video to find out why the next 3 months are crucial. Chamath's financial warning. Chamath's financial warning. Chamath Palihapitiya gave an open warning. The thing is, the average US consumer is likely to have a particularly difficult and sticky period over the course of the next 18 months. Chamath believes that it will continue to grind throughout this year into 2023, and probably even into the early period of 2024. Real wages will decrease, inflation will be sticky, consumption will wane, and profits won't be so fantastic. The unemployment rate will also rise once again. The good news, according to Chamath, is that the stock markets are beginning to bottom out, and most likely by the end of this year or the beginning of the following year, much of that work will be completed. The explanation is that, as you're aware, the equities markets do a respectable job of analyzing the bond market. If we look 6 to 9 months into the future and price that future today, we can say that by the end of this year, or the beginning of next year, we will have kind of hit bottom and can start to build a base. But there's something you should always bear in mind. Let's imagine a stock declines by 20 to 50%. Even if it recovers 50 from that point, it will still be 25 down. Therefore, it's clear that this inflation will remain sticky and persistent for a while. Fed funds might reach or above 5%. However, risk asset will bottom out by the end of this year or the start of the following year. However, things aren't at any odds expected to go smoothly. Follow us to the next segment to know the bitter pill we all have to swallow in line to save ourselves from breaking down. Before moving on, make sure you like and subscribe to our video. The bitter pill. The bitter pill is that a considerable increase in unemployment is necessary in order to tackle the inflation problem. As a result, when interest rates rise, purchases decrease, demand decreases, earnings plummet, layoffs happen, some businesses go bankrupt, and all the bad things happen. There's also this trickle. You know, when there's a low level of employment, it ultimately leads to a political response. People be like, hey, we're losing our jobs. They start requesting action from their politicians to address the issue. After being enacted by Congress, these initiatives and policies, which themselves cause inflation, are implemented. You see, that's why it's so difficult to anticipate how and when this will all end. This is due to the fact that our government seems to have an administration that's enacting and maybe embracing. Inflationary policies are intended to promote what they believe to be greater job conditions and economic growth in this nation. Ironically, many of these policies lead to inflation, which doesn't sound so good. They then impose this challenging central bank decision-making cycle. It's difficult to make a definitive forecast in such situations, since the complexity of the method doesn't seem to have a clear path to resolution. However, internal factors aren't the only driving force. Come with us to the next segment to explore more. Is an energy crisis on the way? Another big question hangs over everything else. These marketplaces are all connected to the cost of energy. Energy is a vital component of several sectors, and it influences cost, as well as the price of food and the armed war in Eastern Europe. Then there are these massive, overarching questions on the financial markets. What will happen with various nations that may default on their debt? And what will happen with China's real estate bubble exploding? Putin reintroduces nuclear weapons. The worst-case scenario may not occur, but the surprise point does. With World War III looming, the market improves. Well, regrettably, the countries don't have access to it. Although they have empirical sampling, it is inaccurate to state that the US economy is automated to the point where they can view real-time data. There may be a Manhattan Project-style attempt to accomplish it for the US at some time, but it isn't happening right now. Right now, US venture capitalists are sitting on $290 billion in dry powder. Look at how much dry powder there has been there. The market has obviously collapsed. How secure are other nations? One viewpoint is that we might not have a clear understanding of how much of this dry powder has already been used. Before the crash, how much of it was actually raised? Is it accurate to say that LP connections to VC companies have been successful? These LPs are strong and remain loyal to their partners, even when the economy is struggling. So if we take a closer look, the venture capital industry is not going out of business or anything like that. This situation can, however, be extremely positive and upbeat. Do VCs have fresh capital available to invest in top-notch businesses? Yes. But does this imply that it will be simple? Well, definitely not. I believe that the threshold has been raised and founder values have decreased. I wouldn't let myself be lulled into a false sense of security after gazing at this Twitter storm. Just be aware that the market will be much more competitive going forward. It doesn't seem to be getting any better based on what we're seeing in the public markets right now, does it? It appears increasingly likely that we will have a double-dip recession. Coming to the end of the video, we must mention that's exactly how it seemed a few months ago. Additionally, the Fed essentially spoke for the Fed in its statement. Next quarter's trends are predicted to be only slightly positive, which might mean a return to modestly positive real growth. However, if all these interest rates begin to rise, anticipate it to become negative once more and a recession.